Hi, welcome to Numerix video blog. I'm your host, Jim Jockle. Joining me today, FX expert Udi Sella. Udi, how are you, sir?
Very well. Good morning, Jim.
So I want to continue our conversation on post-election markets. Last week we had a live conversation on the effects of Trump and Basel, but today I want to kind of jump in a little bit more specific into FX and the European view. So Udi, obviously you're based in Paris. What's the general vibe right now, now that we're kind of about 3 weeks post-election?
Well, let's start with the markets because obviously there are political impacts as well, as we just saw in the elections in France for the primaries for the right. But anyways, in terms of the market, we've seen actually a repricing of financial assets, and the impact has been really across the board. We can touch a few things. One thing is many emerging markets really got slapped, the local currencies. Take Mexico, take the Philippines. In general, the dollar appreciated against all currencies between 5 to 10%. The latter is really for the emerging part, and then there was a massive move of the yield curves, basically yields going higher. You can say this is a part of the Keynesian expansion that your elected president is contemplating. And then, of course, there was a move in the equities. Kind of surprised everyone if we saw the first hours, the markets, the equity markets going down. Since then, we're probably up about 10%. So, in a nutshell, that's it.
And we've also saw a rally in bonds as well, but that seems to have tempered a little bit at this point. Would you say the markets right now are just going to kind of ease back through the end of the year and just kind of poise until some of these new administration decisions have been made to get a better view of what the economic policy is going to be going forward?
Well, I'd say that there is one thing that is still standing and pending, and this is the Fed decision next week. Now the consensus, is that they will hike rates, and basically the future contracts the Fed funds futures are predicting in 100% probability that this would happen. And it is fair to say that we have this unemployment data coming this week, and only if the non-farm payrolls will be shockingly low. The market is anticipating something along the lines of 170,000 new jobs created. And if the number will be shocking, like 20,000 or something of that nature, then maybe the Fed will hold. Otherwise, it's almost a certain fact that the rates will go higher. So that's the only event risk, if you like.
So in terms of strategies, we always get in on what you should be thinking in terms of, from a trading perspective, what are you thinking right now? Is there a particular strategy, particular derivative type that might best position the near-term volatility?
So I guess there are two things to look for, especially one is inflation, because the inflation expectations went higher. So one thing is we saw that in the UK, right, with the weakening of the sterling, and now we see that also in the US, and that's pretty much what the central banks want. So you may be looking, at buying maybe an out-of-the-money option, call option on inflation rates, assuming, anticipating that inflation will be above 2%, which is really what the central banks want, especially I would say in the US and in the UK. And then since there was quite a massive move in the 10-year rate in the US, now it's hovering between 2.3% to 2.4%. So in a sense, the jury is out where the next step is. Will there be a correction once, Mr. Trump selects his team and, policies are put into motion, or will it just continue? So I personally think that the yields would go more higher, if you like. But since it's a market and there's a two-way street, maybe buy some straddles struck at the current levels of the 10-year notes. I think this is where I would be looking.
And in terms of concerns and on your watch list, a lot of talk about obviously moving to a more nationalistic perspective within the U.S., renegotiating trade deals. From an FX perspective, what's on your watch list right now?
Yeah, that's a good question, Jim. Thank you. So, what we've seen, one of the things we've seen and noticed was the euro weakening against the dollar to a very crucial support level of 105, and which is currently it is holding. So this is definitely that I'm looking on or watching, because if this breaks, then we're going to parity, and of course parity has lots of psychological impact, etc. And then I'm also looking at the US dollar against the Mexican peso, which after the elections the same day it broke the 20 peso to dollar level, and now it's trading at all-time low at around 2070. So again, this could weaken further. So we see a lot of pain and grief in emerging markets, and this can carry on, especially if indeed the Fed will hike rates and we'll be now into a cycle of tightening.
Are there any surprise potential winners out there in emerging markets?
Actually, one of the surprise winners is in the G7 markets, and it is the sterling stopped weakening as of the elections day. And in terms of local markets, so I would say that the Russian ruble, and that's of course you can put some geopolitical reasons for that, because of course will the new administration be more favorable towards Russia, etc. So it hasn't strengthened, but it hasn't weakened.
Well, Udi, I want to thank you so much for your perspectives on the FX post-election. Obviously, one of the other areas that we're going to think about is the new year. Obviously, there's always kind of a little bit of a pause, a resetting the tone. Obviously, as we're leaving this year, I think the markets are feeling bullish, but is there anything in that new year, January 1 reset that you have your eye on in terms of a potential trend set?
Honestly, I think what I will be really watching is, again, it's the 10-year note in the US. It is very, very volatile, and I think this really will drive everything else because everyone is looking at the interest rate gap. And the second thing to watch is the dollar against the Japanese yen, because since the elections, the yen has weakened a lot, but at the same time, the Japanese yen is foreseen as a safe harbor, if you like. So it's really interesting to see the two powers, against. Let's see what will be stronger. So I think that's really interesting.
Well, one question there is this change or potential change of where the volatility around the 10-year going to influence some of the negative rate policies like Japan has put in place?
Well, let's look at it this way. So let's talk about Japan. I mean, in a sense, and also in the European Union for that matter. So the weakening of both currencies is actually working in the favor of the central banks over there, because it's making the export more favorable, more receivables, and it's making inflation rise. And indeed, we've seen surprisingly good data coming out of Japan, and simultaneously the growth in Germany has stalled, so they would definitely have an interest in having the euro weaken further, especially the German economy being so sensitive to exports.
Well, Udi, I want to thank you so much, and definitely in the new year, want to sit down and chat with you again, because I think we'll have a little even more clarity as to what this new administration looks like. We'll have clearly some market movements and volatility to talk about in terms of trend setting into 2017. So, Udi, thank you so much for joining us. And of course, we always want to talk about the topics that you want to talk about. Please follow us on Twitter @NXAnalytics, or on LinkedIn, or on Numerix.com. I'm Jim Jockel. Thanks for joining.